What's up, guys? Welcome back to another option video. That's right, we are going to focus on long or buying call options today because it's an investment strategy that I definitely use quite a bit. I'm just going to kind of run through, I think, with some examples on my computer, do a little screen grabbing. That way you get real live examples to see sort of what I'm looking at and what you can look at in order to see how much it's going to cost you, price movement, where it has to go to break even to make money, and where it would go if you, what would happen to lose money, basically those situations. So for me personally, I really like leveraging buying call options. Typically I do this around some sort of event that's going to happen. Very easy and common event that happens for all companies is earnings. Earnings is typically where an event where a stock can move, more than 1 or 2% in a given day. So that's an easy way to look at that. However, when you do look at earnings, obviously the options market is going to sort of bake in that potential price move into the price you're paying for the options. So hopefully what I do today helps you understand what you're going to pay for the options, what your break-even price is, and then what you're risking and all of that. So I guess let's just get into it because it's easier to just explain, show you guys. I'm definitely a visual learner as well as a hands-on learner, so at least I can show you visually. And then I would definitely recommend on your own doing some paper trading, or even just going to an Excel file, looking at options prices and keeping track of them on like a daily basis, even multiple times a day, and just sort of see how the prices fluctuate and how they change based on what the stock is doing. But either way, let's get right into it. Real quick, before we dive into the video, if you're enjoying any of my videos on this YouTube channel, please consider subscribing and giving the videos a thumbs up. Would really appreciate it. Really helps out with the YouTube algorithm, and I would really appreciate it. But anyways, let's get back to call options. All right, so I would say the easiest and one of the free ways to look at options, at least on the internet, I like using Yahoo Finance. I'm gonna use NEO as an example. Not a super high price stock, so I feel like it's gonna be easier. The options premiums won't be as high, so it'll be a little bit easier to follow. But this is basically a Chinese EV car company. So think of them like early Tesla in China. So they're trading at $47 a share. They're up $1 today. I don't know how relevant that is, but either way, at the top here, we can just click on options, and then let's just sort of run through the overview how Yahoo Finance has it structured. So we can see here that you can show it as a list or a straddle. I think I'm just going to leave it as a list because we're not going to be looking at calls and puts at the same time. We're just looking at buying call options today. So this drop down right here, these are expirations. What that means is whatever date you choose here effectively is the day that these options contracts will expire. So December 18, 2020, today's the 18th, which means that these call options will expire at the end of day today, which means they're basically going to trade dollar for dollar with the stock if they're in the money. If they're out of the money, they're going to be pretty much worthless because it means that you couldn't exercise them, you couldn't buy the underlying stock. So they effectively are trading to zero because there's effectively no time premium. So if we just scroll down, you can see that, right? You have the stock up here trading at 47.22, so keep that in mind. You can see that this column is the strike price, so these blue sort of hyperlinked. This is the strike price, which means the price that you can buy the stock at if you buy one of these call options. And then over here you have the last price it traded at, and then the bid and ask column. So when you're looking at the bid and ask, the ask is typically what you would pay. If you wanted to buy it right now in the market, you would have to take the offer or the ask price. That's what you would pay to buy it. And if you were selling it, you would have to hit the bid, or that's what someone's willing to buy it from you for, right? So that's sort of the spread, the bid-ask spread. So you buy at the ask or offer and you sell at the bid or hit the bid. So let's scroll down. You can see that this blue highlighted section is everything that is in the money. This means that the stock is trading above the strike price. So it's trading at 47.22. You can see that 47 is the last strike price that is highlighted in blue before you get to 47.50, which when I hover over it's blue, but it's out of the money, which means that if the stock stays right at 47.22 today, all of these call options 47.50 and above will all expire worthless, meaning $0, because why would you pay for a call option and buy the stock at 47.50 when in the open market it's trading for 47.22, right? You can buy it for cheaper at 47.22, therefore this call option is worthless. So if we look at this one, for example, It's trading at 53 cents. But because a call option represents 100 shares of the underlying, you have to multiply whatever this price is in this column, or in either of these columns really. This is the last price it's traded at. You have the bid and the ask, but basically what you're paying is the ask. You have to multiply this by 100 because it represents 100 shares. So you have to multiply the ask by 100 to get what you would pay. So you would pay $53 for this call option. And what that's saying is that you pay $53 and then you have the right to buy 100 shares at $47 a share. So that sounds great, right? Like you can buy this option contract, you can own the stock at 47, and then you can sell it at 47.22. But you have to remember that you just paid $53 for this option contract. So the way to look at options is you want to keep in mind your break-even price, because whenever you're getting into an options trade, it means that you have to have the stock trading at or above your break-even, otherwise you're losing money, right? So if you're actually paying 53 cents for this trade, or $53 when you multiply by 100, you want to add the strike price to the ask price, and that's your break-even. So that's an easy way when you're getting into an options trade. If you're only trading options and say you're not trading the stock at all, if you are buying this call option for $53 with a 47 strike, you're expecting the stock to be at least at $47.53 by expiration or higher. Otherwise, you're going to be losing money on this trade and there's no point in entering it, right? So right now it's trading at 47.22. That means, do you think that enough is going to happen by the end of the day? Either some sort of catalyst, a news event, a headline, or just the market's doing well and this stock continues higher, right? Whatever it is, you have to have some sort of conviction or belief that this stock's going to be trading higher than 47.53. Otherwise, this stock is going to trade down to whatever the strike price plus X number is to get to where it's trading, right? So for example, if it's trading at 47.22, that means that if all things stay the same, this call option will decrease from $53 down to $22, or 53 cents down to 22 cents, because at expiration, what it's saying is you have the right to buy 100 shares at $47, but the stock's trading at 47.22. So in order to have equilibrium there, in theory, it should only trade at 22 cents, right? Otherwise, you're paying more than you would buying stock in the open market. And if it was trading less than, there's a huge arbitrage opportunity where everybody would just buy these for, 20 cents or 15 cents. And then you could go into the open market and sell it for 47.22. So remember that the break-even price is the strike price plus whatever you're paying for it. And the price that the call option will be worth at expiration is equal to wherever the stock is trading minus the strike price. So that's obviously assuming that the stock is trading above whatever the strike price is. If it's trading below, it's going to be worthless. It's going to be zero. Now, the option, as you can see here, this 47.50, the stock is trading below 47.50. It's trading at 47.22. However, you're still paying $31 for this. That means if you wanted to buy this right now, you would have to expect the stock to be trading at $47.81 by expiration in order to at least break even. And if it's not, then what this is basically a time value or time premium, right? There's still time left before expiration that the stock can trade higher. So even though this call option at the given moment is worthless, right? Like, you can buy the stock in the open market for less than 47.50, so there's no value to buying this call option, because why would you exercise that at 47.50 when you can buy it for 47.22? So the amount that you're paying is a time premium. So anytime you're buying out of the money call options, which is where the strike price is above where the stock is trading, basically you're paying for like volatility premiums, time premiums, all that stuff. All that goes into factor how much this call option will be worth. Any of these, it's a premium, an expectation of like, what are the odds that this stock is going to be trading above this amount, right? So that's the first thing, and the first easy way to sort of look at call options and how they're priced, what you're paying, what your break even is, and then think about where you think the stock's going to go. So if I were to buy one of these call options, paying $31 for these 47.50s, I have to think that there's going to be some big catalyst. So for example, say you think the Fed's going to bail out the market today and do another huge stimulus, right? And the market's going to shoot up. I could, in theory, buy these for $31, and if this stock closes at $48, that means that $48 where it's trading minus the strike price is what this option contract would be worth, which means my $31 that I paid would be worth $50. And from a percentage standpoint, a return on investment, that's pretty good. It's much higher than if I were to buy a share of this for $47.22 and make 70 cents on it, right? If I'm paying $47.50 and I make 70 cents, that's not a big return on investment, right? 70 cents on $47, not much. Whereas if I make $20 on a $31 investment, that's like a 60-some% return. So this is where you get huge leverage from trading options, but you're only risking $31, right? So you're risking 31 to make 20 if you think it's gonna close at $48, let's say by the close, and you buy these 47.50 calls. I hope that makes sense. If you have questions, leave them in the comments. I'll try to clarify it a little bit more if I can in another video, but that's sort of the general gist of buying call options. Please leave some questions in the comments. I would be more than happy to try and answer them to the best of my ability, but that is the gist of call options, how to look at them, how to price them, how to figure out your break even, and I guess how to read Yahoo Finance call option chains. But either way, that's gonna be it. If you enjoyed this video, please give it a thumbs up. Subscribe to the channel. It would really help me out. Helps out with the YouTube algorithm. Until next time, guys, thanks for watching.